Okay guys, welcome to module 3. So far we've looked at iron condors and trapdoors in quite a lot of detail. So today we're going to do something a bit different. We're going to look at the weekly diagonal trade. So very different trade, and I hope you guys will find it interesting. So let's get started. Okay, just as usual, quick disclaimer that any information contained in this presentation is for educational purposes only. Nothing is financial advice or an investment recommendation. Any trades and or results covered in this presentation may or may not be live trades, and all trades are believed to be accurately presented. However, since the trades may not have been executed in the market, the results may have been under or overcompensated for the impact of certain market factors such as liquidity, slippage and commissions, and no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. And as always, check out the options disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. Okay, so plan for today, we're going to talk about weekly diagonals, going to go through the theory on why we trade them and how they can work, go over the trading plan that you guys have got access to, we'll just discuss the details of that, and then quite a few examples to go through, and then we should have time at the end. We'll look at some of the case studies that we've been following along, so the two condors and the trapdoor that we've opened up. We might spend a little bit of time discussing those as well. Okay, so why do we trade weekly diagonals? So it's a good trade after an extreme move, particularly on the upside. Okay, I generally like to put them on when the stock's made a really big move to the upside. Maybe momentum's going to carry it a little bit higher, but generally it's going to stay flat, decline, or maybe go up by just 1-2% maybe. You can also profit with these potentially on the upside and the downside. So if you get a slow move to the upside, you can do well, or if you get a really fast move to the downside, you could do well. Okay. It's a long Vega trade, so it can help hedge other positions. If we have a lot of short Vega in the portfolio, adding some long Vega here can help us out. It can be a short-term trade, so it can be in and out quickly, sometimes on the same day, as you'll see in some of these examples. Sometimes, you might be in the trade for 2 or 3 days, sometimes it might be a week, but it's a pretty short-term trade. Typically, I don't do too many weekly trades, but this one isn't too bad because it doesn't get hit if we get a big sharp move down. It will get hit a little bit if you get a big move up, but the risk of the market really tanking, this trade can actually do okay if that happens. So in terms of the trading plan, it's a short-term trade looking for small gains of around 1 to 3% of our capital at risk. We want to try and enter the trade for a small credit if possible. So we want to get paid to enter the trade. Otherwise, a small debit is okay. Usually around $400 to $500 is the maximum I want to risk, and that's the most you can lose if it goes the other way. Obviously, with all our trades, keep a trading diary and review it weekly and avoid large losses. In terms of the instruments that I trade this on, I do the Russell, S&P 500, Alphabet, Apple. I've also done Amazon and TLT as well. Okay, typically I'm on the Russell, but I will trade some of those other stocks and ETFs occasionally. In terms of capital allocation, we're looking at $10,000 for the calls and up to $15,000 for the puts. Talked a little bit about volatility skew so far. We'll go over that in more detail, but basically if you're doing this trade on the puts, it's going to tie up a little bit more margin because of that skew that there is on the puts. In terms of a trading style, it's focusing on weekly diagonals with between 3 and 10 days to expiry. And we use the daily and the 30-minute chart for our trade entry signals. So if we're doing a diagonal call spread, we want the market or the stock to be really overbought on the daily time frame and also the 30-minute time frame. The worst case scenario for the trade, always good to know, is a rapid move in the direction of the short strike shortly after entering the trade, i.e. within 24 to 36 hours. So again, if we're doing a diagonal call spread and the market shoots up, that's going to be bad for the trade. That's what we don't want to happen. And that's why we enter it when the market's already had that big move up. The best case scenario, there's two. There's the stock could move away from the short strike within a few hours and we can take early profits. The call option that we're short that's closer in time really declines in value, whereas the one 2 weeks in the back holds its value a little bit. So sometimes when the market drops, you can get out really quickly for a little bit of a profit. Otherwise, we want the stock to slowly drift in the direction of our short strike and land in the profit zone on the Thursday of expiration, or Friday, I guess, if you're trading a stock. Okay, so we don't mind if it comes up towards our short strike as long as it doesn't do it too quickly and doesn't get too close. Okay, short strikes, again, pretty similar to what we've looked at, delta around 10 to 15. So that's the option that we're selling, whether it's a call or a put, around that delta 10 to 15 mark. These are for the Russell, so strikes 20 points apart for calls and as high as 40 points for the puts. Okay, again, volatility skew on the put side means we have to put them a little bit further apart. Strikes are always chosen 2 weeks apart. And just in terms of strike placement, again, if you're trading Apple or Amazon or TLT, the strikes are going to be a little bit different. We'll look at some examples, but this is a basic entry guideline for the Russell. Try to enter for a credit if possible, and I'll tell you what that means shortly. Enter when the stock is overbought. We enter a call spread, or oversold. We enter a put spread on the 30-minute time frame, and we try and match the 30-minute time frame with the daily time frame. If we're entering for a debit, so if we're having to pay money to get into the trade, we want to keep risk on the defined risk side to less than $400. So that just means on the downside if we're trading a call spread, or on the upside if we're trading a put spread. And you can see that quite easily on the payoff graph. Exit guidelines: if price gets to within 5 points of the short strike, so again this is for Russell, rules are going to be slightly different if you're trading the stocks. Stop loss of 2%, short-term profit target of 1% within a few hours, and long-term profit target 2 to 3%. Okay, so that's on our 10,000 for the calls or the 15,000 for the puts. Okay, so it's a really short-term trade, in and out pretty quickly. Sometimes you're not going to get a huge gain sometimes, but if we can just get that 1 to 2%, and if we can do that in a week, that's quite a good return. And we want to close on the Thursday afternoon at the latest. We do not want to take it into settlement on Friday. So again, that's for the indexes. For the stocks, they'll still be able to be traded on the Friday, but generally you don't want to take it in too close to expiry. Okay. Okay, so let's look at some examples. Some of you may have seen this one before, but basically we entered on Feb 20th. Russell was at 1160, so we went out and sold Feb 27th, so we've gone out 1 week, 7 days. We've sold the 1190 call, which would have been around delta 10 to 12, somewhere around there. We sold 4 of those. We went back in time 2 weeks to March 13th, and we bought 4 of the 1210 calls. So we've gone out 2 weeks and out 20 points. The ones we sold cost 140. The ones we bought around 195. You can see the trade there cost us 70 cents to enter the trade. If we times that by 4 contracts, cost us $280 to enter the trade. And looking at the starting Greeks, looks really, really good. We've got a little bit of short delta in that we don't want the stock to go up straight away. We've got long Vega, okay, so that's important. If the stock goes down quickly and volatility spikes up, this March 13th call will hold a little bit of its value, whereas this short call will drop really quickly because there's not much time to expiry and the stock's moving further away from the strike. This loses value quicker than the back month one does. So that's how you can make a little bit of a quick profit. You've also got that negative delta. So if the stock goes down, that's benefiting the trade as well. Delta theta ratio is 10%, so really good. Again, trading the Russell, that's a really nice starting point looking at these Greeks. Okay, Vega theta is 1 to 1. You can see here the exit on Feb 26th, exited for 185. Okay, so we've gone 6 days into the trade, we've got out 1 day before expiry, and we've made about $1.15 per contract, so about 400 bucks, a bit over. So this was our starting position. So you can see on the downside here, The most we can lose is the cost of the trade, which was 280. Okay, so the graph's a little bit off, but basically you can see there 200 on the downside. So worst case scenario, if the stock absolutely tanks or the Russell absolutely tanks, the most we're going to lose is $280. And usually, if you can get out quickly, you might be able to actually get out for a little bit of a profit. If the Russell stays pretty flat over the next few days, you can see we've got a little bit of income potential there. And the other way we can profit is if it really slowly drifts up into this area here, around 1175, 1180, and if it ends there very close to expiry, we can do pretty well. You're never really going to make this top section of the graph. That's a little bit unrealistic, similar to the butterflies and the calendars and things like that. The top third of this graph you can almost discount. You never, or very rarely, are you going to make a big profit like that. You want to be aiming sort of, you might get around the $500-600 mark. If we head up to 1170, 1180, as you saw with this trade, made about $440. And I'll show you the chart on the next slide of what happened. So this was the entry in green. So Russell had been quite overbought for a while. We had a very small sell-off and then straight back up into overbought readings. See that green circle there? Entered the call spread there. Russell was pretty flat the next day, so the trade would have been looking good. Then we got a big jump up the next day. So the trade would have been under a little bit of a loss situation at this point. Again, we had that negative delta. The market's moving up pretty quickly. But then it does reverse back down, and again the next day flat again, so the trade's looking really good here. Then the next day another big ramp up. So even though we've got quite close to our short strike's at 1190, we've hit about 1185. So again, that rule of getting out when we're about 5 points, within about 5 points of the short strike. Closed it out, and even though the market's gone up and it's almost touched our short strike, we're very close to expiry. So that front weak option hasn't increased as much as the back one has, okay? So we're short the front one, we're long the back one. The back one's gone up a lot because it's got more time to expiry, and the front one hasn't gone up as much. So it was a little bit of a dangerous situation here. We wouldn't have wanted the Russell to go much higher, and that's why I wanted to close it out. If I had have held it into the next day and Russell ramped back up to 1200, that would have been really bad for the trade. As it turned out, closed on the red arrow there, then the next 30 minutes the Russell really sold off, and the profit would have actually been even higher at that point if I had been able to hold on. But I had a nice gain. I had the $400 gain, which is about 4% on the capital at risk. So I was happy to get out there. Okay, so that was that trade. Next one entered just a couple of days later. Again, Russell's still really overbought at this point on the daily time frame and also the 30-minute time frame. This one entered on Feb 28th. This is a really short-term trade, so an example of how you can make a quick profit on the downside, and we exited later that day. Okay, so Feb 28th, Russell's trading about 1193. We've gone out to 1210, March 6th, so again about a week, and then we go out 2 weeks to March 20th and buy the 1230s. Okay, this trade was a little bit more aggressive. You can see that delta dollar is a lot higher. Okay, and the reason I did that was just I had a bit more of an opinion that the market was ready to go down. Okay, if I go back to the chart, you can see we're really overbought. We've just been going up a lot recently. We've gone from, over the period that this chart shows, from the very left at about 1125, we've gone up to 1195. We've gone up a long way in a short period of time. I was pretty confident that the market wasn't going to continue too much higher. We've been hitting those overbought readings quite regularly. So a little bit more aggressive. Okay, so this one cost a little bit less. We're selling the 1210s for 285 roughly, buying the 1230s for 340. Roughly, the actual trade cost us about 40 cents. Because it cost a little bit less, I was able to trade 5 contracts. So 5 contracts times the 40 cents is $200. That's the most we could lose if the stock went down. Russell sold off later that day, and I was able to exit just before the close for 80 cents. Okay, so I've made a really quick profit of about $200. So it's gone up 40 cents. We've got 5 contracts, 200 bucks. Okay, because we've got that negative delta, as the market's gone down, we've benefited from that. We're also long Vega, so we've benefited from that. Again, just looking at our starting position, the delta theta ratio was around 20%, so a little bit more aggressive than the first one, but still okay. And Vega theta is fine as well. I think this one, trading at 285, the delta was probably a little bit higher, so maybe it was about a 15 delta rather than a 10 delta in that first example. So this was the initial graph at starting the trade, so you can see a lot higher profit potential if Russell stays flat. The profit zone is a little bit closer, so we've got a little bit less margin for error. And again, on the downside, the most we can lose is about $200. Okay, so what happened with the trade? So you can see here, really overbought. I've also got that red line at the bottom there, which is classic case of divergence. So the market's sort of making an equal high, whereas the indicator's making a lower high. Just indicates that momentum is slowing a little bit. So that's another really great signal if you can see something like that. Again, I haven't marked it, but you can see another one just on the next peak on the indicator. Another example of divergence, a little bit of divergence. RSI and stochastics makes a high, not long after makes another high, but it's a lower high, even though prices stayed about the same. So entered on the green arrow, really quickly the market sells off and closed it out for a quick profit. So that's how you can make money if the market drops really quickly. Again, we're long Vega, we're short Delta, so we benefited from that. Okay, next example, another short-term one, an example of the market reversing really quickly. So entered on March 3rd and exited an hour and a half later. Now this was on the put side, so this was just after the previous example. The market sold off pretty hard, so I've done the opposite. I've done it on the put side. I've gone out to March 6th, so this was a really short-term trade. Generally I'd want to be more like the 7 to 10 day, but I was pretty confident that we'd get a bounce. Sold the 1140s, and with the puts again had to go out that 40 points instead of 20 points because of the skew. So that means the capital at risk is a little bit higher. To work out how much margin we're using on this, you take the difference in the strikes times the contracts. So 40 times 3 is 12, or 40 times 3 is 120, and then times 100, so 12,000. Okay, whereas the previous examples we were 20 points wide, 5 contracts, so 5 times 20 is 100, and times 100 again is the 10,000. Okay, so because we're a little bit wider, only trading the 3 contracts, this one cost us a little bit more, cost us $1.25. Again, just wanting to keep that defined risk a little bit lower. 3 times 125, we've got about 375 is the most we can lose if the market goes the other way, rallies in this case. Okay, so again, keeping that risk on the opposite side to about under $400, $500. Exited an hour and a half later for 164. So a little quick profit, about 40 cents times 3 contracts, about 120 bucks, in an hour and a half or so. Again, these sort of trades, sometimes you want to be able to be watching the trades pretty closely. So if you are doing these sort of things, this is the only strategy I trade where you'd need to be watching the market pretty closely. All the rest, you can just kind of check the markets at the end of the day. Whereas this one, if you've got a trade on, and I don't do them every week, but if you've got one on, you generally want to be watching pretty closely. Okay, so starting position delta of 22, delta dollars of 25,000. Theta is really, really high because we're trading a lot closer to expiry, only 3 days to expiry. So our delta theta ratio is really good, Vega theta ratio is really good. Okay, so a little bit of a different Greek setup, but all still looking good. So this was our position. Again, if the market stays flat, we can do okay. If it goes down just a little bit, we might do okay. And if it reverses quickly, we can do okay. What we don't want to have happen is the market tanks really quickly. Okay. So the opposite sort of graph to what we were looking at with the calls. where all of our margin, our $12,000 in margin, is on the downside, and the most we can lose if the market rallies is that $375 or so. So this was the trade, entry on the green, exit on the red. So we've sold off really hard, dropped from 1193 or so down to 1160, 1165 pretty quickly. Got into an oversold reading and we've bounced up pretty quickly, and that's how we were able to make a quick profit. Again, this is one of the few examples I've got trading the puts. I generally don't like to trade this on the puts because what could have happened here is the market could have continued selling off and we would have been in a little bit of trouble. I would have had to have been pretty quick to exit the trade. Okay, lucky got the timing pretty right on this one, got in pretty much right at the bottom. Market reversed and the trade was good. But you do need to be a little bit careful if you're trading the puts, because the market can have a capacity to crash down, whereas it doesn't really crash up. Generally it just grinds higher, which is kind of what you want with this trade. Okay, so be very careful with the puts, and again, I don't trade the puts all that often, tend to use this strategy more with the calls. Again, you can see the market really rallying hard again the next day. We've gone from 1165 up to about 1210, 1212. That would have been another good time to potentially put on a weekly call spread, diagonal call spread. Again, we've traded sort of flat to slightly lower over the next 4 days. That trade would have done okay. Okay, so next example, this is the exact same time frame that I was talking about. So entered on March 4th. So again, after we've had that big reversal rally, got into that overbought condition. Haven't got the Greeks here, but Russell trading at about 1210. We've sold the 1230s. Again, really short-term trade. I tend not to do this too often. This has only got a couple of days to expiry. A little bit high risk for me usually. But again, we'd had that really massive rally, so I was fairly confident that the market wouldn't continue too much higher. We'd kind of trade flat over the next couple of days. You can see here we've got a negative price, okay, negative 0.07. We're buying the diagonal spread. So if we're buying it for a negative price, we're actually receiving money. Okay, so in the first 3 examples, we've been paying money. In this example, we're receiving a credit. And again, remember that from the trading plan. We want to try and enter for a small credit if we can, or at most a small debit. So in this case, if the market goes down, the worst case scenario is that we're actually going to make a little bit of money, like 20 bucks or something. Okay, so nothing really, but we're not going to lose anything on the downside. With this one, again, did something a little bit different, went out 30 points wide, so 2 weeks, and then did the 1230, 1260. Again, because it was quite close to expiry, I had to do that. As a result, I traded a few less contracts. I only traded 3. So 3 times the 30 is 90, so 9,000 capital at risk. So I entered that at lunchtime on the 4th, exited first thing the next morning, and it was trading at 50 cents. So the front week option that we've sold has really dropped in value really quickly because a bit of time has passed and the market hasn't done anything, whereas the back week option has really held its value. So the difference there is 57 times the 3 contracts, about $165 in profit. Okay, so not bad for a trade that I've only held for a few hours. Okay, so this was the entry. Again, we've had massive rally. We've gone from 1165 up to 1212. So we've gone up over 50 points in about a day, basically, because it was halfway through that day, and then halfway through the next day we hit the top. Again, got fairly lucky with the timing, got pretty much the exact top. Then the next morning we've dropped down a little bit. That front week option has just lost all of its value, and the option that's 2 weeks in the future has held its value, so managed to get out for a nice gain. Okay, again, just that really, really overbought reading. You know, you can see RSI is up above 80 on the 30-minute time frame when I've entered. That's really, really overbought on the short-term time frame. Okay, so that's what I'm looking for. So next example is on TLT. So you know, it's an ETF, so it's generally not going to move around too much. As I said, I mostly trade this on the Russell, but I have got a few examples of ETFs and stocks to share with you guys. Again, I want to be really careful if I am trading a stock that there's no news items scheduled, there's no earnings releases, things like that. Obviously TLT, I don't have to worry about that too much unless there's a Fed announcement or something like that. But this was the trade. So January 20th, TLT diagonal call spread. So I don't know if you remember back at this period, bonds had a massive rally. TLT had a really, really strong rally and was really overbought. Just looked like the rally was completely overdone. So it had a really strong run up and is looking very overbought on the daily and 30-minute time frame. I would expect momentum to carry the ETF a little bit higher over the next week, but not too much higher. Okay. As such, a diagonal call spread makes sense here. Ideally, we want TLT to be around 138 to 139 in a week's time. I haven't got it on this slide, I've got it on the next slide, but at the time TLT was trading at around 135. So didn't get a great screen capture here, but I sold the 140s January 30, so I've gone out 10 days, so perfect. Gone back 2 weeks to Feb 13th, and I've sold the 145s. Can't see it there, but you'll see it on the next screen. Again, I'm buying it, and I'm getting a negative price. So I'm actually receiving money, so I'm getting a credit for making this trade. If TLT tanks, the worst that's going to happen is I just keep that credit. I've made a small amount of money. Okay. Now I'm trading 10 contracts here. So the most or the worst that's going to happen on the downside is I'm going to make $80. Okay, so I've got no risk on the downside at all. Again, we're 5 points wide, so trading 10 contracts, we're risking about $5,000 on the trade. Okay, so if we go to our initial Greek setup, so a little bit of a different graph in that you can see on the downside, the worst thing that's going to happen is we're going to make a little bit of money because we've received that credit. Okay, we've got around 5,000 at risk in the trade. Ideally, we want TLT to head up to 1137, 1138, maybe even 1139 if it happens sort of the day before expiry. Okay, negative delta dollars of about 9,000, so pretty similar to what we had with that first Russell example. Again, our delta theta ratio is going to be a lot different just because TLT the value is so much lower. So again, I don't really have rules in terms of delta theta ratio for TLT, but more I'd be looking at that delta dollars example. Okay, so 6 days later, TLT has basically gone nowhere, still trading around 134. So I managed to close it out, took a small profit, closed it for 6 cents, which was a gain of $140. So we received $80 when we entered the trade, and then when we closed it, we're selling it for 6 cents, we receive another 60. Okay, so the 80 that we received initially, the 60 that we get when we sell it, we've made 140 in total. Okay. So again, looking at expiry there, delta dollars has come right down. All of our Greeks have come down a lot. A couple of days before expiry, I could have potentially held it another few days in the hope that maybe TLT would rise 1 or 2% from there. But I was happy to just close it out at that point. Okay, so this was the trade entry. Again, just looking at that graph over the course of 3 months or so, we've really rallied from 106 all the way up to 129, which is a massive move for bonds, right? Bonds generally don't move around too much. So this was a really, really big rally. Was looking quite bubblish. I haven't got the 30-minute time frame here, but if you look at the daily time frame, over the course of late September through to January when we traded, RSI hasn't dipped below 50. So it's just been a really strong rally. We've also had three goes at getting above 70 on RSI in the last few weeks. So this rally was just really, really strong. We're a massive way ahead of the 50-day and the 200-day moving average that you can see there, the blue and the red lines. So again, that's exactly what I'm looking for. Potentially it's going to go a little bit higher, but shouldn't really go too much higher. And then again, a classic case of divergence. I haven't marked it here, but where the green arrow is, you can see RSI is up at around maybe 75. A couple of weeks later, TLT makes another high, a higher high, but RSI makes a lower high. So momentum is declining, and then sure enough, bang, it sells off afterwards. So we'll cover that divergence in the technical analysis module, but again, that's another perfect thing to look for in terms of the charts. That divergence. Momentum is really slowing because price is making a higher high, the indicator is making a lower high. It's not matching up. Okay, next one, a couple of days later, Jan 28th, again, TLTs are still really, really overbought. Went up 1.7% on that particular day, so doing another diagonal spread, this time placing it at 141, 146, and using Feb 6th, Feb 20 expiry. Filled at 0.09. A few minutes later, the midpoint was about 12, which was slightly better. But again, trading the 10 contracts, we're buying the spread for a negative price. So we're receiving money. So the 10 times the 9 cents, we're receiving $90. That's the worst that's going to happen on the downside is we get to keep that $90. Obviously, you've got to take into account commissions as well. So Jan 28th, going out about 9 days or so. Feb 6th, 141s. Again, TLT was at about 137 at the time. Selling the 141s, going out 2 weeks and buying the 146s. So again, 5 points wide, 10 contracts, we're risking about $5,000. Okay, so very similar to the first trade, we've got no risk on the downside. Okay, the worst thing that's going to happen is we're going to make a little bit of money. We're happy if TLT drifts a little bit higher, or if it falls quickly because we've got that negative delta. Okay. Interestingly, Vega is 0 here, so the Vega of the two options offsets. We've got positive theta, so if TLT does nothing, stays where it is, we're going to make a little bit of money over the next few days. As it was, TLT rallied a little bit over the next couple of days and then really dropped back off again. So again, that front week option has really lost all of its value. The back week option has held a little bit of value, and we've been able to close it out for a gain. Actually, I think this one I just let expire. So that was the expiry there, I think, Feb 6th. And because we received the credit, we received the $90. The two options just expired, and we just got the $90 credit. So that was the gain on the trade. So 90 bucks over 5,000 is 1.8% on the trade. So again, in that sort of 1 to 3% range we're looking for, so that's pretty good. Okay, so back to Russell, got one other example on the Russell. So this one was July 13th, 2016. Russell, again, looking overbought on the 30-minute and the daily time frame, so diagonal call spreads come into play. We go out roughly 10 days for the short call and look at a strike of around delta 10, which was the 1240s. For the bought call, we go out 2 weeks in time and up 20 points, which gives us the August 5th 1260 calls. The spread was trading at around 37 cents, so a cost of $185 to enter the trade. So we're buying it. It's a positive value. It's costing us a little bit of money. So we've got a little bit of, we could lose a little bit on the downside if we let them expire. That was the trade. So short the 1240s, we go out 2 weeks, buy the 1260s. This was our graph. So this is a zoomed out version. Got around 10,000 at risk in the trade. Can lose a little bit on the downside if we let them expire. We've got a little bit of short delta to start with. Again, this is a pretty standard setup for a Russell diagonal call spread. Delta theta is under 10%. Vega theta is a bit over 1 to 1. Pretty standard setup here. We've got about a 2%, 2 to 3% margin for error on the upside, so it can go a little bit higher if we want it to, but not too much higher and not quickly. Okay, so if I zoom in, this is just what the graph looks like. So again, we're looking for that little drift higher or a quick sell-off. So in terms of the chart, in terms of the entry point, if we have a look at that, again, you can see over the course of this chart period, really overbought. We've gone from 1090 all the way up to 1210 over the course of a couple of weeks. Really overbought on that 30-minute time frame. We've been above 80 on RSI for almost 3 days. So that was a good entry point. Okay, really overbought. Maybe momentum's going to carry it a little bit higher, but probably not going to go too much higher. Okay, so really nice setup on this one. Okay, so on the 19th, so far the trade has been uneventful and is up $90 at the close of business. At one point today it was up 160, which would have been an okay point to take profits. So right here about 90 bucks. Again, it's not a huge amount of money, but it's quite a fun trade to put on if there's not much else happening in the markets. If you haven't got your condors and things like that, you can make a little bit of money in a short space of time sometimes. And then a little bit further on in time, I think we ended up making a little bit more money on it, maybe about 200 bucks or so, you see from the graph there. So that was what it was like when we closed it out. Again, that front week option has lost a lot of value. It's only worth 20 cents. And the back week option has held a little bit of value. Okay. So the spread's now worth about 90 cents or so. Okay, so on the 20th, I guess the next day, we got a nice little pop in Russell, which has benefited this trade. We're heading up into the profit zone as we approach expiry, which is perfect. As long as we stay below 12.30 in the next day, we should be looking pretty good. The near-term option has decayed to almost nothing, while the back week option has held its value. So currently up about $200 at this point. Okay, and there's the chart there. Okay, so again, that entry point on the daily time frame really overbought as well on the daily time frame. Had this massive rally up, and we just kind of trade sideways, which is perfect. Okay, so ended up making about $200 on the trade. Okay, Amazon example. Okay, so this one's a little bit different. Again, I tend to prefer not to do the stocks, but I will do them occasionally if I see something that's really overbought. Tend to prefer the Russell, but this one, we'll go through the Amazon example. So August 3rd, 2016, at the time Amazon had a pretty strong rally. It was looking quite overbought. So looking at selling the 790 calls, I think it was trading at 755 at the time. So going out about 9 days, selling the 790s, then going out 2 weeks and buying the 820s. This trade would make sense if you think Amazon will rally slowly but not get above about 780, 785 over the next week. The 790s that we are selling are trading slightly higher than the 820s, so we'll be entering the trade for a small credit, which is perfect. So again, we're receiving a little bit of money, and we've got about a 4.5% margin for error before hitting the short strike. So volatility on Amazon is a little bit higher, so as a result we were able to get a bit further away, but the risk is that Amazon makes a big move because the volatility is higher. It's more likely to make a big move, so it's good that we've got that margin for error because we may need it. Amazon's just reported earnings, so we don't need to worry about that. Always check earnings dates when trading individual stocks. So again, made sure that Amazon didn't have earnings. It had just released earnings, so that wasn't an issue. If you're trading a stock, always check the earnings, okay? Exit points. So again, from our trading plan, I've adjusted these for Amazon. So exit if price gets within 5 points of the short strike. So if it gets to 785, stop loss of 2%, so around $180. Again, we're 30 points wide. We're trading 3 contracts, so we're risking about 9,000. Short-term profit of 1% within a few hours. Longer-term profit 2 to 3%. Close on August 10th, no matter what. Okay, so a couple of days before expiry. So this was our initial setup. Again, we've entered for a credit, so we've got no risk on the downside. Amazon can go to 0 and we won't lose any money. We'll actually just make a small amount. Delta dollars, really nice. Little bit of negative delta, but nothing major. and all the Greeks look really good to start with. Okay, zoomed out version, risking about 10,000. The only reason I don't like Amazon as much as Russell is you can see the profit potential is a lot lower for the amount of capital that we're risking. If you go back and compare it to the Russell graphs, you'll see that. Okay, but this one turned out okay. Again, zoomed in version. I think this was when we closed the trade. Greeks were at -7, so still had a little bit of negative delta. Actually, this was an update, sorry, August 4th, so Amazon has gone up a little bit the next day, so we're actually down a little bit on the trade. Amazon's gone up nearly 1%. We're down a very small amount on the trade. Just looking back through the details here. When we initially received a very small credit of about 7 cents. And then the spread now has gone out to about 20 cents. So we're down just a little bit, a couple of bucks, maybe 50 bucks or so, okay? Amazon's rallied, we had negative delta, but we've also picked up a little bit of time decay. Again, maybe not an ideal entry point. We weren't quite as overbought as we could have been. You see the previous peak on stochastics and RSI, that would have been a good entry point. And a few other good entry points that you can see there where Amazon's really overbought and then just has a quick pullback. Better entry point would have been right at the end of the graph here when we're up at about 775. Okay, but we came out okay on this one. So I think I'm missing a slide there, but basically made a little bit of money on this one. I think it expired worthless, so basically flat on the trade. Okay, so when do we use weekly diagonals? So after a big move up, when you expect maybe another 1 to 2% rise over the course of the next week, but nothing more than that. You're either expecting a small rise over the next week or a sharp pullback. Also, when overbought conditions are reached on a daily and 30-minute time frame, and we try to enter for a small credit or a small debit. So ideally, we want to enter for a credit if we can, so we've got no risk on the opposite side. If we do have to enter for a debit, we want that to be fairly low, so we don't want to have too much risk on the other side. Okay, so rookie mistake, trying to adjust. Okay, we don't bother adjusting these trades. It's a short-term trade, and with such a small amount of time to expiry, the chances of successfully adjusting the trade are slim. We either take profits if the targets are met, or we close the trade if the stop loss gets hit. Don't try and get fancy. So we put it on, we close it, that's it. Or we let it expire if we've got a credit on the downside. Now the other thing that you can do, potentially, looking at that Amazon example and some of the TLT ones where we received a credit for the trade, what you can do is let that front week option expire, and if you want, you can just continue to hold that back week one in the hopes that you get a big bounce and maybe you'll make a bit of money on the call spread. Generally, I'll let the front one expire, and at the same time I'll close the back one, but you can hold on to it if you want, and it's basically a free call option if the market does rally a lot. Okay, so we don't try and get too fancy. Okay, so that was it for the diagonal spreads. Next session is going to be module 4, the bearish butterfly. Again, we'll go through the theory, we'll go through the trading plan, talk a little bit about the scaling in and how that works, and then lots and lots of examples, and talk about the best time to trade bearish butterflies. Okay, so big session on bearish butterflies next time. Okay, thanks guys. I'll stick around and answer some questions, and we can also maybe take a quick look at a couple of the case studies that we've got going on. Okay, why is long Vega good for a position if the market goes down? Okay, if you're long Vega and the market drops, generally volatility goes up, so that benefits trades that are long Vega. Okay. All right, I'll bring up some of the case studies that we've been looking at. while there's any questions coming through. So start with the March unbalanced iron condor that we were looking at. Okay, so this is our current position. Again, I'll add a purple line for maybe 2 weeks from now. We'll zoom in a little bit. We've got positive delta, 22,000. That's okay. That's within our risk parameters. We're pretty central still. The market's dropped a little bit, maybe about 15, 20 points. Still got 7% margin for error on the downside and 7.5% margin for error on the upside. Our initial position started with negative 5,000 delta dollars. Okay, so market's gone down, we've now got positive delta. Okay, so we want the market to go back up a little bit, but otherwise we're not too bothered. It can stay pretty flat. We're maybe down a little bit on the trade, just because the market's gone down. Maybe volatility's gone up a little bit, but generally pretty uneventful trade so far. Okay, I'll compare that to the April one, and then I'll get back to the questions. Okay, so the really interesting takeaway here is that the market's done the same thing. It's gone down, but our delta hasn't changed quite as much. This one's moved a lot slower. Our delta dollars is only 10,000 compared to 22,000. So we've got less directional risk on this one. We've still got about $3,500 in income potential in the trade. We started with about that. So this trade's basically flat. And again, pretty uneventful so far, looking pretty good. 2 weeks from now, looking fine, okay? All right, so a couple of questions coming through. Is there a scenario to do a diagonal on the put and the call side? Yeah, so that would be a double diagonal basically. This is more of a directional trade where you're thinking of, really, really overbought. Double diagonal, you can do them. I wouldn't say it's a bread and butter trade of mine, but you can do them if you're expecting sort of neutral trading, but maybe an increase in volatility because you're going to have a lot of long vega. So it can be potentially a little bit of a hedge for a condor in terms of that vega. But again, they're going to get hit if there's a big move either way. Even though there's long vega, if the market moves really quickly towards one of your short strikes on either the put or the call side, the trade can suffer a bit of a loss. Okay. If most of the increase has been due to earnings, does the strategy still work, e.g. Apple this week? So I wouldn't trade the strategy around earnings at all. Too risky. I guess, yeah, if the increase has been due to earnings, I'm assuming you mean the volatility increase. Generally what happens with volatility is it increases into earnings, and then once the earnings announcement comes out, the volatility really drops. Yeah, so I just generally wouldn't trade the strategy around earnings. It's too much risk of that big price move. Like you said, Apple moved about 6%, so could have got this trade into trouble potentially. Yeah, with the move up in Apple, would you think a diagonal, or do you think too much volatility? Yeah, so definitely not a bad time to be looking at Apple. If we bring up the chart, so pretty overbought on the daily time frame, so that's really good. We've had this massive gap up, so looking good on the daily time frame. If we go to the 30-minute time frame, not quite so overbought. So I'd probably, a really good time to get in would have been up here at the top when we were really overbought, and we're up around 130.5. If Apple does rally back up to around 130, that might be a good time if we can get back to that overbought reading on the 30-minute time frame. So that's where I'm talking about. You want to try and match up the daily time frame with the 30-minute time frame. Daily is looking pretty overbought, but the 30-minute time frame is actually a little bit oversold. Maybe we're going to rally back up here. Who knows? We could also come back at some point and fill this gap. You just never know. But in terms of the actual strategy, I'd be looking for overbought on that 30-minute time frame. That's kind of the crucial thing that you're looking for. So not quite there with Apple. Why do we buy further out from the sell strike? What would happen if we buy closer to the buy strike? Well, it'd be a different trade. If you're using the same strike, it would be a calendar spread, so a little bit different. If you're meaning further out in time and you want to bring the trade closer and you're using the same expiry date, it just becomes a bear call spread basically. So these are kind of the rules that I've developed that work pretty well with this strategy. You could go further out in time with the option that you're buying. Just means the trade's going to cost you a little bit more. You're going to have more risk on the downside. Okay, so quick question on interactive brokers. So someone wants to know how to populate the strike. So let's say I've got most of my Russell ones set up already, but if I want to add the May options, I tend to keep them separated by month. Now I've got a few too many, so it's splitting them onto 2 lines, but generally what I do, I'll just type in Russell, options, hit the More tab to find the date that I want, and then I can go and add them one by one if I want, but it's a little bit painful. The other option is just add all for May. That's all of them there, and then I usually just sort by delta to get them in order, and I just delete the ones that I don't want. So I'm not really interested in any of these ones that are deep in the money. I'll delete those. Also not interested in any of these ones. And then I just separate the calls and the puts, and then I just delete some of these really deep out of the money puts that I'm not really interested in either, and then that gives me my options. So that's how I do it. Okay, so again, long Vega benefits if volatility rises. So if you've got a long Vega trade, the market goes down, volatility rises, it's good for a long Vega trade. Okay, so generally any trade that's long Vega is going to benefit from a fall in the market and volatility rising. Okay, now you've got to also keep in mind delta, but generally speaking, just with volatility, if you're long Vega, market going down is good. If you're short Vega, market going up is good because volatility drops. Okay, so it's kind of long Vega, you want market going down. Short Vega, you want market going up. Does an iron condor on TLT increase our overall delta dollar risk? I'm assuming the correlation on TLT and RUT is relatively high. I think TLT might actually have negative beta, to be honest. Bonds and stocks maybe move opposite. We can check. Let's see if we can just do it like this. Maybe we'll use IWM. Okay, so I think this is what you're asking, but let's assume we've just got a really basic portfolio. We've got 100 shares of IWM, we've got 100 shares of TLT, so we're not even trading options. We've got delta dollar exposure is positive, but if we look at beta, TLT's got negative beta, so it moves opposite to how the general stock market will. So yes, it does increase our delta dollars, but if you look at our beta weighted delta dollars, TLT is actually negative. So you can also look at this number if you want, if you're trading lots of different underlyings. GLD as well generally has negative beta. It moves in the opposite direction to the market. So that can be a way to reduce your risk a little bit if you trade that way. Okay, so the other case study that we were looking at was the trapdoor. which again has been pretty uneventful so far. Okay, so if I go to our initial setup, Russell was at 1360 when we traded it, so we've come down a tiny amount. Delta dollars was at 1,200, we're now at 3,000, so market's gone down a little bit. Our Delta dollars has increased a tiny bit. Profit potential was initially at about 500 on this bit here. We're still around the same, so we've maybe made a tiny bit of money, but generally very uneventful on the trade so far. Our theta's gone up from 38 to 40, so it's gone up a little bit. Vega's come down a tiny bit, but again, nothing really happening with the trapdoor so far, and I'll keep you guys posted via email on those ones. In terms of a case study on diagonals, I don't think we're really overbought yet on the Russell. So just looking at the chart, we're not overbought on the daily, and we won't be overbought on the 30-minute time frame either. So I wouldn't be looking at call diagonals on this one. Okay, so really a bit of a mess. Like here would have been a good time when we get this big rally. We're really overbought. Back here as well. Maybe you could do one on the put side here after this big sell-off. But right now we're very much just in no man's land, so I wouldn't be looking at doing one. But if I was going to do one, I'm just going to close this to get them back all in a line. Okay, so what are we at? We're Feb 3rd. So if we go out a week, we've got the Feb 10s here. Let's see, there are only 5 delta, so they're probably a bit low. If I add in some more, we want Feb 10, yeah, 1390 maybe at 11 delta, looks pretty good. I've already got that down here. So we could potentially sell that one, the 11 delta, for about $1.50 or so. And then we'd want to go out 2 weeks to Feb 24, and we'd want to be looking at about the 1410. Did I get those right? Feb 24. Sorry, bear with me here. So Feb 10, that one, 1390. Feb 24th, 1410. Yeah, there we go. So I'd look at something like that. Sell that one, and buy that one. So we'd sell that one for about $1.50. We'd have to buy this one for about $2.90. It's going to cost us about $1.40. So we're paying money. Probably wouldn't want to trade more than about 3 contracts or so. So not a perfect example. Again, the timing is not great either. And to set up the order, you just do a combination, option combo. Front week's going to be Feb 10. Back's going to be Feb 24th. Doing a call. Front strike 1390. Back strike 1410. So we can add that in. So again, if we're buying one diagonal spread, we're selling the Feb 10 1390. We're buying the Feb 24 1410. So we'd want to buy this one. Midpoint is going to be about $1.45 or so, $1.50. So probably around 3 contracts gives us our $1.50 or so. Yeah, exactly. Talking about the beta again. Yeah, having uncorrelated underlyings is a good idea. So you can trade condors on the Russell and then have one on TLT, and they're potentially going to move opposite. Now the only bad thing, I guess, is you know, if stocks go down, bonds go up, you know, potentially you're getting hit on the Russell on the put side and TLT on the call side. I mean, yeah, it takes a bit of testing, but it can help reduce your general exposure for sure. Would this morning at about 10:30, 11 be a decent time to enter a diagonal on NASDAQ? Let's take a look. Yeah, so about 10:30, we're a little bit overbought. Not too bad. Yep, and we've basically traded flat, so the trade would be looking okay so far. Probably a better time would have been back here. Look at how overbought we were back on the 25th, and we've been overbought for an extended period of time. You know, you don't necessarily want to get in as soon as you hit the overbought reading, which would have been here. The NASDAQ rallied a bit from there. You know, this is perfect. If you see this overbought reading for over a day or so, so around the end of the day on the 25th, up around here somewhere, and then we trade pretty much flat for 2 days. You could get out of the trade there. Market drops the next morning, you could potentially get out for a decent profit there. You know, the front week option would have decayed completely, and the back week might still have a little bit of value. You know, another example, maybe back here on the 6th, been pretty overbought for a while. You know, up around here, market sort of just drifts slightly higher over the next 4 or 5 days. That would have been a really nice time to enter. So currently, you know, I'd like to see it get a little bit more overbought. Yeah, I mean, it would have been an okay time for sure. We're definitely overbought. There's a little bit of divergence there as well, you can see. So yeah, not a bad time to enter. All right, guys, any other questions? Okay, guys, looks like the questions are drying up, so I might sign off. And as always, if there's any other questions in the meantime, feel free to email them through or hit me up on Skype. Next session will be on bearish butterflies, so really big session there. We've got lots of examples to go through, lots of good stuff. So looking forward to that. Have a good weekend, everybody, and I'll talk to you soon.